If your car was written off today, would your insurance payout be enough to replace it? Most people assume the answer is yes, until they file a claim and discover a painful gap between expectation and reality. Hidden inside your policy is a decision you probably overlooked: the difference between agreed value and market value basis of settlement. And that single choice determines whether you walk away from a claim financially stable or financially exposed. Hello, and welcome to Insurance World TV, your trusted platform for simple, practical insurance and financial knowledge. Today, we're breaking down one of the most important concepts in motor insurance: the difference between agreed value and market value. Many car owners only discover this difference after an accident, and by then, it's too late. In this video, you will learn what agreed value and market value really mean, how each one affects your claim payout, how insurers actually calculate your compensation, and how to structure your cover so you never face a shortfall again. Stay with me. Question 1. What is agreed value? Let's start with the first concept. Agreed value in motor insurance is a valuation method where the value of your car, commonly referred to as sum insured, is agreed upon at the start of the insurance policy period, and it stays valid for the entire insurance period. The agreement on the vehicle value is always arrived at by way of having an independent valuer value the car for insurance purposes. Once this value is fixed, it remains valid for the entire period, and any claims payment is made on the basis of this agreed value, subject to policy excess and terms. For example, if you insure your car for 1,500,000 Kenya shillings on an agreed value basis, and there is a claim during the cover period, the policy will pay you 1,500,000 Kenya shillings, without applying depreciation or market value at the time of the claim. It is common knowledge that vehicles depreciates a lot in a year. So by the time cover reaches the 8th or 9th month of insurance cover, the value may have reduced from the original 1.5 million Kenya shillings due to wear and tear or market forces. Even if this is the case, under agreed value basis, the policy will pay the value, or sum insured, of 1.5 million Kenya shillings, which was agreed upon at the beginning of the policy. Agreed value gives you certainty and predictability because the value is decided before the loss, not after. However, it is important to know that at renewal, the insurer will value the vehicle again and adjust the agreed value to reflect depreciation or market changes in the new insurance year. So it requires regular review to remain accurate. As you may have noted, the agreed value as a basis of settlement in most insurance contracts are valid for 12 months, or for the entire policy period. However, there are some insurance companies in the Kenyan market who apply the agreed value principle for a period less than 12 months. In this kind of arrangements, your vehicle will be covered on agreed value basis for the first 6 months of the policy, then have the basis of settlement revert to market value for the remaining 6 months of the policy. This could be beneficial to the insurance companies applying this kind of underwriting when they are insuring a heavy-use units, such as Ubers, taxis, commercial vehicles, etc., where the rate of wear and tear is very high. Now, before we define market value, Let me ask you something. When you buy insurance, what do most people focus on? Most people focus on the premium. Many will ask, how much does it cost? But very few ask, how much will I actually be paid when I lose my car? And that's where this distinction becomes critical. Question 2. What is market value? Market value, on the other hand, refers to how much a particular vehicle would reasonably sell for in the open market immediately before a loss occurs. It is a method of valuation used by insurers to determine the compensation payable to a policyholder in the event of a total loss, such as theft or a write-off following an accident. Unlike agreed value, which is fixed at the beginning of the policy period, market value is not predetermined. Instead, it is assessed at the time of the claim, based on prevailing conditions and the specific characteristics of the vehicle. The concept of market value is grounded in the principle of indemnity, which underpins most general insurance contracts. This principle seeks to restore the insured to the same financial position they were in before the loss. No better, no worse. Therefore, rather than paying an amount that was agreed in advance, the insurer evaluates what the car was actually worth just before it was damaged or lost. In determining market value, insurers consider several factors. These include the age of the vehicle, its mileage, overall condition, service history, and any prior damage. They also analyze external market data, such as the prices of similar vehicles currently being sold in the second-hand market. Depreciation plays a central role in this process, as most vehicles lose value over time due to wear and tear, technological obsolescence, and general market trends. For example, a car that was purchased for 1,500,000 Kenya shillings may have a significantly lower market value after 1 year of use. If the vehicle is involved in an accident and declared a total loss, the insurer will assess its current worth, perhaps 1,200,000 Kenya shillings or less, based on the factors mentioned above. This assessed amount becomes the basis for compensation. One of the main advantages of market value insurance is that it can typically result in lower premiums. Since the insurer is not committing to a fixed payout amount up front, they retain flexibility in valuation, which reduces their risk exposure. This makes market value policies attractive to cost-conscious policyholders, particularly those insuring standard, widely available vehicles. However, market value also presents certain disadvantages. The most significant is the uncertainty surrounding the final payout. Because the value is determined at the time of loss, policyholders may receive less than they expect, especially if the vehicle has depreciated significantly or if market conditions have shifted. This can lead to dissatisfaction or disputes between the insurer and the insured, particularly if there is disagreement over how the value was calculated. Additionally, in environments where vehicle prices are volatile, due to factors such as currency fluctuations, import duties, or supply constraints, the market value may not accurately reflect the cost of replacing the vehicle. In such cases, the compensation received may be insufficient to purchase a similar car, forcing the policyholder to cover the difference out of pocket. Market value in motor insurance is a dynamic and flexible valuation method that aligns compensation with the actual worth of a vehicle at the time of loss. While it offers the benefit of lower premiums, It also introduces uncertainty and potential financial gaps at claim stage. Understanding how market value works is essential for policyholders, as it directly influences the adequacy of compensation and their ability to recover financially after a loss. Let me bring this to life with a simple story. The story of Peter and Daniel, two professionals working in the same office, with same income level. Both bought similar cars, same model and same year of manufacture, at almost identical price. For the purposes of insurance, Peter's car was valued at 1,200,000 Kenya shillings, while Daniel's car was valued at 1,250,000 Kenya shillings. They both insured their vehicles comprehensively, including excess covers, with different insurance companies. However, while Peter's insurance policy was arranged on agreed value basis, Daniel's policy was structured on market value basis. This is where their separation began. After 6 months, they both suffered misfortunes that led to total loss claims. Peter's vehicle was stolen from an overnight parking lot, while Daniel's car was written off due to an extensive fire damage that burnt the vehicle while parked outside a business premise that caught fire spreading to the parking lot. Come the time to accept the settlement offer, Peter was given an offer of 1,200,000 Kenya shillings, which was the agreed value throughout the policy period. Daniel, on the other hand, was offered a settlement of 1,050,000 Kenya shillings, an amount which was adjudged to be the approximate market value of his vehicle at the time the loss was reported. Peter's experience with his claim under the agreed value basis. Peter files his claim. The insurer checks the policy. The agreed value is clearly stated. No debates. No negotiation. He is paid exactly what was agreed. He walks into the market and replaces his car. Minimal disruption. Daniel's experience with market value base. Daniel files his claim, but now the insurer begins assessment. Mileage, condition, market prices, depreciation, etc. Days turn into weeks. Negotiations begin. Finally, Daniel receives an offer, but it is less than expected. Not enough to replace the same car. Now he has two options. Add money from his pocket to replace the same car, or downgrade to an affordable vehicle. That's when he realizes the benefit of having an agreed value clause on a motor policy. Advantages and disadvantages. Here are some advantages and disadvantages of these two bases of settlements, itemized individually, starting with advantages of agreed value basis of settlement. Number 1. Predictable payout. Number 2. Faster claims. Number 3. No valuation disputes. Number 4. Ideal for financed or unique vehicles. Now, let us look at the disadvantages agreed value basis of settlement. They include: Number 1. Could attract higher premiums. Number 2. Needs review at renewal. Number 3. Risk of overinsuring. Advantages market value basis of settlement. Number 1. Could attract relatively lower premiums. Number 2. Reflects real-time depreciation. Number 3. Suitable for common vehicles. Disadvantages of market value basis. Number 1. Uncertain payout. Number 2. Possible disputes. Number 3. May not cover replacement cost. Number 4. Slower claims process. So, how do you choose? Always choose and negotiate for an agreed value basis, unless the market value basis offers a premium discount and you are interested in that. Motor insurance is not just about having a cover. It's about what happens when things go wrong. Because the real test of your insurance is not when you are paying for it. It is when you are claiming from it. If this video has changed how you think about insurance, like, share, and subscribe to Insurance World TV. And if you want help structuring your motor policy the right way, reach out. Because the best time to fix your insurance is before you need it.